Okay, welcome guys. This is the last topic and it's looking at cash budgeting, or a cash flow budget and a statement of cash flows. So, just going to introduce it. It does follow on from the last topic. We started looking at the difference between cash and accrual. Now we're just focusing on the cash part. Okay, so we're just basically throw away the accrual part, we're just looking at cash. So, last time we covered the important thing that cash flow is not the same as profit. You can be making profit and cash flow, you might not have the cash there. We're going to be adding in a few extra sources of cash today, and so we're going to actually be expanding it a bit more from last time. So, businesses can fail. If you do not recognise that you've got a liquidity crisis, if you don't have enough cash to pay the bills. So the first part is we're actually going to be doing a cash flow budget. So we're actually going to be looking at cash flow budget over the next few months and tracking what is the cash required over that time. What's needed for in the bank, what's needed to be paid out, and actually looking and considering what do we need. Now, important thing is that the hotel industry is quite unique because you do need cash budgeting. Because very often, if we have a look at revenue for a hotel, you do have a peak season or a busy season, and that's when revenue goes up. So you do have that peak season. In the off-peak season, very often this is the time that cash deficits can occur. So you don't have quite enough cash coming in, but the expenses are still there, you have to pay the bills. And so sometimes these can be the times of cash deficits, but your peak season is your times of cash surpluses. So it's being aware that when you've got a peak time, making sure you keep enough surpluses to get you through those times of cash deficits. So I mentioned surplus and deficit. Surplus is a time when you've got more cash coming in. A cash deficit time is when more cash is being paid out. And it's not just because of operating expenses like revenue and expenses. We're now going to be adding in a few extra ways that you can receive cash or pay out cash. So in the PowerPoint, yes, we can earn money from our sales. That's pretty easy, that's a revenue. But we can also borrow money from maybe a loan. So we can have proceeds of a loan come in, so we can borrow money from a liability. Or we can sell an asset. Again, these are different ways that we can have money coming in, different sources of income. So we've got a revenue, we've got a liability, or we can sell an asset. Same thing can go with some cash payments. So before, yes, we had various expenses like wages or other operating expenses. That's fine, that's our normal expenses. But we can also have to spend money by maybe repaying part of that loan. Or maybe we want to purchase an asset. All these things require cash. Now, some of these things don't appear on the income statement. They're not revenue, they're not expenses. But they're very important for cash flow and actually budgeting cash flow to make sure we have enough money in the bank to pay for them. So, when we're producing a cash budget, this is sort of the layout that we're going to be using. We have a cash receipts section, a cash payments section. Just one little change we're going to be doing here. We're going to be adding in an opening bank balance. So the opening bank balance is our balance at the start of the period we're looking at. That's what we start with. Then we get our total cash receipts, our total cash payments, and then we come up with our predicted closing bank balance. So we have, for each month, what we think the money we're going to start with, the money coming in, the money going out, and the closing. What you do is you go this figure, opening, plus cash receipts, minus cash payments, will give you your closing bank balance. Your closing bank balance, maybe that's the end of January, whatever, that then becomes your new opening balance at the beginning of February. And then you repeat the same process again for the new month. Okay, so this is a cash budget. This looks at what we think we're going to end up with cash over the next 3 months. Now we do add another column. We do add a totals column. So we want to know the totals for each of these items. You don't need to do it for the opening and closing bank balances, but everything else you need to total. Now, when we do the totals, is we do the second step, which is a statement of cash flow. A statement of cash flow looks at categorising each of these sources of cash or spending of cash. Looks at categorising them into 3 different categories. One of them is called operating. Operating, just think day-to-day operations. These are our normal revenue, normal expense items. And we're going to list out what comes in and what went out within that category. It can be quite helpful because we can see on a day-to-day basis, are we achieving cash? Are we actually getting more cash in on a day-to-day basis? Second good category is called investing. Investing relates to non-current assets. Think about, I invest in this investment or invest in this shares or things. It's the purchase and sale of non-current assets. So that's your investing category. The final category is financing. Financing is borrowing money. Either you borrow money from the bank or you borrow money from the owners as owners' equity. Either way, it's borrowing money, it's financing the business somehow. Under each category, you're going to have an inwards and an outwards using these total figures. Then you come up with a net cash figure. And the net cash figure is the net movement over that 3-month period. How much did cash change? Or how much do we think the cash will change over that period? So that's a statement of cash flow. It's a summary of where the cash is coming from and where the cash is going to for that 3-month period. Okay, so how to analyse it? Well, you've got some case scenarios in there. Work through doing a cash budget and a statement of cash flow. Once you've done it, you'll notice that some periods have a period of low cash. Maybe there's a cash deficit, low bank balance. What could be done to help these hotels through this period? What could they change? Could they, maybe if you look over here, could they change when they purchase some things? Could they delay the purchase? Could they borrow more money? Got to think about how the sources of cash and how they're paying out cash. And making sure that the bank balance actually remains above zero, because that's an important thing. The other part to analyse is looking at, operating, how's their day-to-day operations? Is the operations actually producing cash? Is it a positive figure? If it's not, then it's probably bad news. Investing, how much have they spent on assets? Is that a good thing that they've spent all that money on assets? Financing, sometimes when you borrow a lot of money from the bank, yes, it shows up as this is the source of financing, but overall, if you keep on doing that long term, it's not a good thing. So this is where the money is, the sources of financing, sources of income, sources of cash, I should say. So is it a healthy sources of cash? So give it a go. You've got some scenarios that you can work through. For each one, prepare a cash flow budget, statement of cash flow, and just start to think about, is this a healthy hotel, and what could they do to change it? So that's the last topic. We're looking at cash. When you go come back next year, you will take this to another level, just doing a bit more work on cash budgeting and sort of a bit more analysing. So anyway, signing off. So congratulations, final class, and well done.